One of the most consistent, high-paying junior jobs in the entire world is that of the private equity associate. In private equity, you buy companies and try to sell them at potential profit. And if you're at one of the largest funds in the world, that means you're dealing with huge sums of money. Now, the private equity associate position is typically the junior role at all these large firms. You're typically responsible for financial modeling, doing diligence, and completing important presentations. So it's a lot harder to find good salary data in private equity, but we started by looking in the H-1B database specifically at mega funds from this list that we compiled. Now, the base salary, which is the guaranteed salary that you're going to get at these top funds, is between $140,000 and $175,000 per year. The average across most of these mega funds is about $125,000. But really the crazy element of pay comes in when you think about the all-in numbers, when you include the bonus. And the bonus range that you're going to be exposed to can vary pretty wildly, but what I've seen at the very top funds is that they can pay up to 150% of your base salary. Apollo, for example, is a huge fund that pays close to the top of street, and they've reputed to be paying their associates up to $400,000. From my personal experience and that of my peers working at the top funds, you can typically expect to make between $300,000 and $350,000 if you're working at a top mega fund. Here's a great table from Go Buy Side's compensation survey, and they show how your pay really does scale depending on the size of the fund you're at. So if you're at a fund that's between $2.5 and $5 billion, it's definitely upper middle market, then you're on average getting paid about $275,000. At the larger firms above $5 billion funds, you get paid an average of $315,000. Now, in contrast that to the mega funds, some of these mega funds have funds up to $20 billion, and that's why their pay scales so much. You can see that in general, 30 to 40% of funds allow co-invest. That's when you can invest alongside the fund into the portfolio companies that you're buying. That could give you more returns. It's a good source of alternative investments that most mid-20s people won't have access to. One of the bad things about working at a mega fund is that most of the time you don't get carry. And carry is the profit interest that the fund itself is generating. So if you make a good investment, that means you don't get to directly benefit from that investment. You'll still get paid a lot of money by way of pure cash, but it doesn't come in the form of the specific profit interest. In general, at the smaller funds, between 13 and 18% actually receive carry, so it's not super common, all things considered. So there is a reason why everyone in banking is trying to break into private equity. You get to learn about businesses, you get to make actual investments, and the pay is generally quite a bit higher. So if you would like to learn more about private equity, we actually just launched our own recruiting course. And this includes 5 comprehensive LBO models, how to deal with headhunters, as well as all of the questions that we were asked during recruiting. So I hope you enjoyed this video, and we will see you in the next one.